My name is Lewis McClellan. I am the editor for the Digital Monetary Institute, and I'm going to be hosting our panel on tokenization and the plumbing for capital markets. And yes, my panelists are joining me now. Thank you, everyone. Maybe if I slide this over a little bit. Thank you. Feeling quite isolated in the middle, but not to worry. Thank you, everyone. Yes, today we're going to be discussing tokenization and applying digital technologies to capital markets. What are the benefits and what are the challenges that still need to be overcome? I'm delighted to be joined today by Amar Amlani from Goldman Sachs, the head of EMEA Digital Assets there, Claudine Herman, Director of Infrastructures, Innovation and Payments at the Banque de France, Benjamin Muller, who banking operations at the Swiss National Bank, and Monica Sa, financial regulation partner at Clifford Chance. Just before we get started, we've got a poll on Swapcard, so you can access that on your apps. Just discussing, in a world of tokenized financial transactions, what is the appropriate medium for the cash leg of the transaction, which is something I'm sure we'll be discussing on the panel today. So it'll be interesting to see what the audience's views there. So is this something that we'll be conducting through existing payment systems? Do we need a central bank digital currency for that? Stable coins, tokenized versions of commercial bank money? Or is there another solution not included there? I'll just kick off. I think I'll come to you, Amar, if you don't mind. Let's just start off with just kind of a survey of what tokenization means to you guys, and what are the kind of range of assets that you're looking to tokenize, and what are the benefits that you would accrue?
Yeah, definitely, and thank you for having me. Yeah, it's a really good starting point, I think, because tokenization is such a broad term and can mean so many different things. So the way I really split things out is into two sides. So native tokenization and non-native tokenization. So just briefly touching on them, native I view as assets which are originated only in the form of a token, and really begin to change the number of intermediaries involved in the process of the creation of a security and the trading of that security. And the other side of that is non-native tokenization, where you take existing assets, segregate them with existing custodians, and then have representations which then move. But you still have the underlying infrastructure behind the scenes. So I think that is the very first differentiation to make between the two different forms of tokenization. And we're beginning to see a lot of progress across both in the market. There's multiple solutions out there on the non-native side of things, which are already up and running, with hundreds of millions, if not billions, already being transacted on them, and then a lot of native digital issuances, especially in the last 6 months, which I know we'll touch on later on. I think, aside from the difference in intermediaries involved and whether you retain or have new intermediaries, I think one of the big differences is, from my perspective, is scalability and liquidity. With non-native tokenization, you have the ability to take assets and bring them back into, I call it today's world, and still have that access to liquidity, whereas with native tokenization, you do often have a struggle day one, which is a more limited network on which you can move those assets. So that's sort of the way I look at things.
Thank you. Yeah, and Benjamin, maybe I'll come to you on the question of we've obviously seen some of these blockchain native securities coming out. You guys have been involved in the issuance of some of these. When there's the possibility for the removal of intermediaries that Amar alluded to, how does that affect your thinking on these things, and the roadmap to kind of making this a widespread market product rather than the isolated things we've seen so far?
Yeah, thanks, and also thanks for having me today. So I think the model that we have today is very well compliant with the model that we could see when DLT and blockchain is used. So you could very well imagine a world where you still have kind of the two-tier financial system with intermediaries, banks, but also other financial institutions that allow end users to access such assets, tokenized assets, and to settle payments. So it's not necessarily in conflict. However, it's clear, and I think we see some of this development already in today's market, is that it has the potential to take out some of the intermediaries. So I think we will see where the journey takes us. But still, I think, And you can look at a blockchain data today, some of the end users still prefer to go through an intermediary to access those markets.
Yeah, that makes sense. Claudine, can I come to you? I wanted to maybe just take a step back and talk about why, obviously you guys have also been active in some of the blockchain and tokenization projects. What is the benefit that you're hoping people will achieve from this?
Well, thank you also first of all, for having me here. Very happy to be here among you. Well, there are indeed various benefits which we have tested when carrying out our experiments on wholesale, CBDC and tokenization of assets. I would say the main benefits that we have found are, first of all, the efficiency of settlement as tokenization, both on the, let's say, the securities side and also on the settlement asset side, can actually improve and have instantaneous and atomic settlement, which cannot always happen on all market segments. So I think it's an important feature. Then the availability of 24 hours and 7 days can be also an advantage. I would also add the advantage of having enhanced transparency, and I think this would be important both, for example, for the issuer, who can actually check and also have a complete and exhaustive view of the holdings from well, the users, the investors, and also certainly regarding controls over AML and the financing of terrorism. I think also we are, let's say, on a learning curve. We have not assessed yet all the benefits, and I think there are probably some further avenues to explore, including on the decentralized, the tools from the decentralized finance. And that these could perhaps also enhance and be as a complement to DLT. And so this is what we are currently experimenting with the Swiss National Bank and also the Monetary Authority of Singapore and the BIS Innovation Hubs to inject these tools like the automated market maker to see how they can work in this ecosystem.
Thank you. Well, a lot to dig into there. And if you're interested in decentralized finance, we'll have a very interesting panel on that at 4 o'clock today. And you might see me there again. So you mentioned transparency as a benefit there. And I think, as you pointed out, there's a lot to be said for being able to see holdings from a CTF and an AML perspective. But there is also a downside to that, right? There's a limit to how much transparency people want in financial markets. You don't necessarily want your counterparties to see your holdings. Is it possible to, that could be market sensitive information if you're a big investor. Is it possible to balance enough transparency for, help the AML perspective with transparency, but keep information that needs to be private? I can maybe throw that open for everyone. I don't know. Yeah.
Well, I can start maybe. I think there's a possibility really to inject enough privacy to ensure that the most confidential aspects of transactions are being, let's say, preserved. It's a question of authorization on the nodes. So because it's quite a flexible system, I think this can be accommodated. But I will let other panelists give their view.
Sure. Monica?
I mean, I would just say that that transparency, I think the whole point of the financial crisis and the changes of the regulations from MiFIR and also implementation throughout the world is about shining the light on trading. So I don't think transparency is the bad thing. The question is whether or not it might hinder large transactions, and which still could be done off-chain. So I don't think I would flip the question. I'm not sure that transparency is a bad thing, because you want to have trading to be transparent for proper price discovery. Mind you, I'm a lawyer, so that's my understanding. But on the flip side, you do need identification of for AML purposes. That's separate from transparency of trades.
Sorry, Amar, you were going to say?
I agree. I think often one of the properties of blockchain, the fact that it is a single source of truth, often gets put to the side in favor of tokenization, which of course is the topic of today, but the single source of truth element has a lot of benefits to it in the right scenarios, as we were just saying. And I'll take an example, which is just even reconciliations, right? And the fact everyone runs on their own ledgers today, and then quite often you have different teams calling each other to confirm certain aspects, right? That happens on a huge scale across the industry today. It's a very inefficient process, and that is, in my mind, something relatively easy which can be solved with the transparency that a shared ledger has to offer. But as the team was saying here, it's got to be the right use case, and there's certainly areas of financial markets where you wouldn't want to give complete transparency.
Yeah, absolutely. But it does seem like there are the technical tools where you can have that balance, so it's not too much of a trade-off. Ben, can I come to you and talk about some of the challenges? Maybe talk a little bit about the project you've been working on with the Bank of France, and what are the I guess some of the remaining roadblocks to more widespread adoption.
Yeah, I think it's a great question, and so our perspective on this is that we will not see a big bang migration to blockchain and DLT. We think this is not realistic and probably also not good practice for regulated financial institutions, but rather we're going to see an evolution. And an evolution usually is costly, because it means that you might need to run two parallel systems. You need to run today's system, and you might run new DLT-based system. And it's quite a while until you really can harness the efficiency gains of the new technology. And I think this is well, yeah, that's kind of, if you want, so a roadblock. But yeah, it's going to be exciting to see how this evolution will evolve. Yeah.
Anyone else got other challenges to add to that? No.
I think. Sorry, systems integration is just a huge one. I think a lot of the focus always goes to liquidity, regulation, but systems integration. I think we have to remember that, institutions over 10, 15, 20 years have all got their own bespoke systems which have branched off into different directions. And recent trades, as a firm at Goldman, we've started doing just even trading to the nearest minute. It was a lot of work to uplift our existing systems to be able to function and do things to the nearest minute. They can do it, but they just never needed to in the past. A lot of systems out there are batch driven at the moment as well. So we think about 24/7, how is that going to operate? So I think systems integration is huge, and I think one of the other challenges with it is everyone's going to be doing bespoke work. I think TMS systems will have a big role to play here, but I think if you think about the big institutions who typically have bespoke systems, everyone's going to be going off and needing to solve their own work.
Well, let's talk about the payments leg a little bit. I think it's a very interesting point, and obviously you guys have been very involved in that. Let's talk a little bit about the poll question that we said at the start, right? It seems like realizing the benefits of tokenization is going to require a means of settling the cash leg of the transaction on chain. I think that's probably fair to say. Claudine, what are your thoughts on whether that on-chain cash settlement solution should be provided by a central bank, or it can be provided by a private entity, perhaps?
Thank you. Well, it's a very good question. Just recalling that indeed we are here on the financial markets side. So indeed, what the pilot regime has introduced is very new, because it will allow cash settlement on using exemptions. So when central bank money is not available, it will allow the settlement in other forms of money that could be stable coins, like electronic money tokens, or commercial bank deposits. So that's a possibility that has been provided by this regulation, indeed, to test these new DLT possibilities for settlement. Actually, though the pilot regime very clearly frames the conditions under which this can happen, and especially it puts some caps on the transactions, on the volumes, and all this has to be approved by the authorities. So I think it's an important matter to be looked at by authorities. but still, it does not remove the fact that, well, from a central bank point of view, settlement in central bank money is the safest way to settle assets in systemic markets, because financial stability is at stake here. So indeed, the challenge is really the ability to provide central bank money in this tokenized form, or in a form that can indeed help the settlement of tokenized assets themselves. So there are different ways to do this, and different manner to explore. And I think, well, the Eurosystem has clearly announced that it's going to engage in an exploratory phase to test various possibilities to settle these tokenized assets. But I think what should be really the most prominent thing to retain is really the aspect of financial stability and the safety of the settlement. In central bank money carries no liquidity or credit risk. It's completely safe and secure, and this should not be forgotten in this changing landscape.
You know, I think we need to be careful about definitions, because we started off with Amar doing a really good job defining, you know, separating out tokenized securities with native digital assets. And I think the question is, what do you get? So with a tokenized security, you don't get necessarily any access to the underlying. With a digital security, you get a claim against the issuer. On CBDCs, as opposed to central bank money, I think. So when you look at the first EIB.
I think your mic has a problem with just tagging it out. We've got another one there for you.
Oh,
just
great.
yeah.
So when you look at the definition of CBDC versus central bank money, one example is the recent EIB issuance, which was settled by the Banque de France central bank currency, but it really wasn't, it was a token, as you say, tokenized of a claim against euro. So it itself, the token, was not legal tender. It wasn't discharging the payment obligation in itself. You still needed the fiat to be transferred to the EIB, although the trade was backdated by contract. But so what do you have in terms of the central bank money? Do you actually have legal tender? Is it equivalent to note and a coin that it could be used in exactly the same way? And I think from an economics term, you do want something to be like that, because otherwise there will be price differential. And then secondly, if it's just, you know, a deposit that is an account-based, which ends up being money created at the private level, at the commercial bank level, like normal money, is it, again, what is it? Is it an account? Is it debt? So I think there has to be some level of granularity and some thinking about what you actually get. And as a investor, I would think I'd rather, as I agree with, that, you know, they'd want to see a payment where you don't have credit risk, that it's legal tender, versus a stable coin where you take, if you accept that as discharging your obligations, you have credit risk on the issuer.
Yeah, I'm sorry. Please.
Can I comment on those 2 points? So first of all, on the question on the poll, I think it's very interesting. I'm looking forward to see the results. But to provide you with a perspective from Switzerland, so we have one initiative in Switzerland, a financial market infrastructure that is live and operating on the basis of distributed ledger technology. And we have another one that is on the trajectory to do so. And what is interesting is that the 2 initiatives actually opt for 2 different cash settlement approaches. So one has decided to issue their own settlement token on ledger, and to use that settlement token to settle transactions. The other initiative says, no, actually, we're going to opt for an approach where we settle on traditional payment rails. So they essentially link the distributed ledger technology platform, their financial market infrastructure, to the RTGS system in Switzerland. and the cash leg would be settled in central bank money in the traditional payment rate. So what I'm trying to convey here is that we might not see one solution. Actually, we're probably going to see different solutions. And SNB has announced in March that we're gonna go forward with the investigation of settling tokenized assets in central bank money, and we're actually gonna proceed the two options, and we investigate both options. And on the point, just very quickly on Monica, I appreciate the legal perspective. I think the legal perspective on the topic is to some extent underestimated. We have banks, we have economists talking and discussing about the topics, but the legal aspects are critical, I think. And I think we have shown in one experiment that we did together with the BS Innovation Hub and banks that it's actually possible to issue a CBDC that would even qualify as legal tender. So I think we can make sure that we have that legal certainty that Monica talked about. Mm.
Yeah, I mean, it's very interesting. If it's not legal tender, as Monica said, there might be a price differential, but I mean, if there's a very high degree of confidence in the operational resilience and so on, then maybe that price differential is basically zero, and we might get used to it. But I guess, yeah, philosophically and legally, it would be nicer to feel like it was you were trading in legal tender, as I guess the market is currently used to. I wanted to talk a little bit about how we get from where we are now with isolated projects to a more widespread market utility. So, you know, Goldman Sachs, obviously you've got the digital asset platform, there's SocGen's Forge, HSBC, and Citi, and a few others that have other plays in this space. What we've seen in the crypto world is that connecting DLT infrastructure like that is not necessarily easy, and that's where we see a lot of hacks and challenges there and so on. How do we get from a situation where there's isolated projects to something that is interoperable? We get, you know, I guess the problem we all want to avoid is fragmenting the liquidity of the market. So yeah, how do we get from where we are now to something that's more seamless?
Yeah, obviously aside from stating the obvious, which is a lot of it needs time and adoption
Sure.
and people to get familiar. I think that's definitely going to be something. You know, everyone needs to go through their own learning journey to understand the technology, understand the risk, understand the different legal concepts. So I think that is already in flight just by the number of digital issuances you're now seeing in the market, right? You could argue it used to be sort of 1 or 2 a year, and now you're almost seeing one or a handful a month. But the other key thing is interoperability, and you know, we had the pleasure of working with the Banque de France and Central Bank of Luxembourg on the bond issuance we did for the EIB, which actually had connectivity between the platform we had built and the platform that the digital money was running on. Now, I think that's going to be what you begin to see more and more and more of. There's multiple different interoperability solutions out there. You know, Digital Asset Holdings recently announced the Canton network as well. So you get that sweet spot of, is it interoperability between two chains, or is it people sort of being established on the same network and then interoperability being a lot easier within that network? So I think that is going to be what we begin to see more and more of to really to protect against exactly what you mentioned, which is the fragmentation point.
Yeah. Anything to add?
I mean, sorry, go ahead, please. No, go.
Yeah, I would completely agree. Still some way to go to work further on interoperability. Probably, as Benjamin mentioned, there will be some coexistence between the traditional FMIs and DLTs, maybe on some niche products. We don't know yet, but certainly I would think perhaps that also standards might be an important matter to be looked at from an international point of view.
Yeah. Monica?
Well, I agree that interoperability is both on the cash leg as well as the payment leg as well as the asset leg is very key, because you can't have, you know, a permission blockchain for this particular token or native security and another blockchain for something else. You have, nobody's talking to each other, and you want to be able to trade, move your payment from one blockchain to another, or vice versa in terms of the security leg. So it is a big challenge from a technical perspective. I think from a legal perspective, it's also a challenge, because at the moment, you're seeing permissioned blockchains where you have the issuance and you've got legal docs. So to be to be clear, you just don't have a token that's a smart contract and everything is defined in terms of your rights on the smart contract. You still have all the documentation that you need in the traditional world for that token or for that native, whether it's tokenization or native. So you still have your offering memorandum, you still have your secure, subscription agreement. The content may be different because it's reflecting different things, but so you've got the paperwork sort of designed for a particular token on a particular blockchain. So how does that sort of, does that need to be rights to be transferable, when you're not part of that blockchain and you've already signed up for the subscription agreement? So there is a legal point about the interoperability, both in terms of at the asset level and the payment level, but also interoperability between the systems itself. So like, for example, an mBridge sort of payment structure, you still need to join mBridge as a central bank. What is the basis on which you're joining? What are the rules that you need to comply with? So the interoperability bridge, for want of a better word, also may have rules that you need to think about. So it is, the infrastructure rules, but also the asset level rules.
I fully agree. I think interoperability is key, and I would like to bring in another aspect. Probably panelists have a say to it as well. I want to focus on interoperability, which is necessary in order to ensure the uniformity of money. So in today's financial system, we can exchange 1 Swiss franc for 1 Swiss franc, 1 pound sterling for 1 pound sterling, $1 for $1, and it actually works. People do not realize the differentiation, for instance, between central bank or commercial bank money. And we at the Swiss National Bank, we are thinking about what would that look like in the future. So would due to this fragmentation that Louis mentioned, would we move into a stage where you could potentially risk that uniformity of money, where you have a Swiss franc stablecoin or a Swiss franc CBDC on one ledger that is not necessarily exchanged at the one-to-one exchange rate, if you want so. And I think interoperability could be the remedy there to ensure that we ensure that uniformity. So.
Yeah, absolutely. I wanted to ask. Amar talked about disintermediation a little bit earlier, and I wanted to come back to that and see what the other panelists' views are on what we can, what can be productively disintermediated. And there are obviously certain parts of the chain that are enshrined in law, and I'm wondering if we need regulation changes to get the most out of tokenization from an efficiency perspective. Monica, I'd be interested in your thoughts on that.
So Claudine mentioned already the disapplication under the EU pilot scheme of a number of rules that are hindrance or obstacles for the issuance of the native token. So, for example, the most common that everybody sort of pulls out is the CSDR, the requirement that if you're going to admit to trading a security, then it needs to be in book entry form at a CSD, and any transfer of that security needs to be eventually recorded in book entry form in a CSD. So that automatically means that you need to have a CSD in order to be able to list and trade your security on a blockchain, your digital security. And that was what has been suspended in the EU pilot regime. But I think the difficulty is that you want to have a legal regime that is technologically neutral. So you don't want to disapply certain things just for the technology and not for the traditional. So I think there's this sort of, the pilot regime and the sandboxes and the UK FMI sort of sandbox is going to flesh out all the rules that need to be changed, and whether or not they should be changed is another question. I mean, what you found is that, got national regimes that are specifically that have specifically changed the rules. One, to make them equivalent. So, for example, Luxembourg has said they've changed the law to say that financial instruments include financial instruments on DLT. So you want to have technologically neutral definitions, but also you want to be able to have requirements in bigger picture, whether or not it's a register, what is a register? Does that register need to be paper or, on a traditional like Crest or whatever, or can you have it on blockchain? So do you need to change the laws to make things neutral? But when you're changing the laws to make neutrality between the digital ecosystem and the traditional ecosystem, are you making it a disadvantage to the traditional? So I think you need to be able to go through that analysis, and I think that's what the EU sandbox is going to be pulling through.
Yeah. Claudine?
Yes, I think Monica has a very good point here, and I fully agree. We are actually entering a new phase. I think it's going to be an interesting one, and we are really eager to see the private actors joining this experiment on a big scale to see how it works, because it will have a 3-year period for experimenting this regulation and these new technologies, and we'll have to learn lessons from this. So we have to make sure that indeed traditional FMIs are not at a disadvantage, but that we can incorporate new technologies. I think it's a bit like Mika. We will have a learning by doing an approach, and probably need to adapt the regulation following this experiment.
Yeah, absolutely. I mean, it's interesting because, on one level, it could be a CSD that rolls out a blockchain-based solution for this, and I wonder. I mean, in some ways, that might, because of their position at the center of the market, they have an advantage in terms of setting standards that other people adopt, and Euroclear and others are going in that direction. Do you feel like, I guess, what does a world look like where it's somebody like Euroclear that rolls out an infrastructure that everyone uses versus a world where laws are changed and the CSDs are disintermediated? Either of you, if you want to take that, yeah.
Happy to give it. I think one thing not to underestimate is the amount of collaboration taking place, because to be honest, I'm the pilot regime, the EU pilot regime, the upcoming UK FMI sandbox, they're all, as the guys were saying, they're almost evening out sort of who's able to participate and helping assist the liquidity argument. But majority of the industry now has got digital assets teams always building platforms, and people are working on each other's platforms to get trades done, because at the end of the day, you still need multiple, maybe joint lead managers or custodians or asset servicing participants involved. So I'm less worried about the overarching, who's got the license to do a certain activity, because I think there is that collaboration and that role for everyone in the industry to be playing.
Yeah, on the legal basis, I think I can probably provide some perspective from Switzerland here as well. So on the one hand, if you have a technology-neutral regulation, it should actually be possible, and we have one case in Switzerland with SDX, Six Digital Exchange, which is a CSD and an exchange, and the CSD is running on DLT. So we actually have that already today, and it's licensed as a traditional CSD under the Swiss Financial Market Infrastructure Act. Then on the other hand, in 2021, the government has introduced this so-called DLT law in Switzerland. You should think of this not as a separate law, but rather amendments to the existing security law and the Financial Market Infrastructure Act that should enable and support DLT applications. But also there, you see, it's not necessarily a new law, but it's rather adaptations to the existing law. So I think these are probably the two roads to take, or probably to coexist. That you use existing regulation, or rather apply existing regulation to such new technology.
Yeah. Anything to add on that from you guys?
I mean, we've talked about the issuance part, but clearly MiCA is broader than that. It's from a non-financial instrument perspective. So MiCA regulates financial instruments and service providers that aren't dealing, or that are non-financial instrument crypto assets or digital assets. But the MiFID, the existing MiFID regime, covers the tokenized securities or the other sort of native issuances which are considered to be financial instruments. So you have to look at the regime, the MiFID regime and the MiCA regime and the UK equivalent and the Swiss equivalent to see whether or not issuing on DLT, a security, a digital security, complies with all the requirements. So, can you do the transaction reporting requirements? Can you do the as a SI or as a financial institution is doing how do you actually comply with the transparency requirements? So, there is that element of while the existing regulation should be able to, and maybe tweaked to accommodate the digital DLT capital markets or activities, I think you still operationally need to tick the box and say, oh, well, this is how we can comply with all these requirements, which isn't very simple. It's creating, for financial institutions, it's sort of, well, you have your own digital asset regime. You have to do a lot of thinking about making sure that you're satisfying your own regulatory requirements.
Yeah, absolutely.
I think also another aspect will be really the market take-up of all these new technologies. And well, as a central bank, we are also very much looking at what the market expects, also in terms of settlement of assets and the safety of all the, let's say, the system. So a solution will work only if it is accepted by the market and only if it is seen as safe.
Yeah. One sort of differentiating factor between some of the technologies that I thought would be interesting to delve into is whether you think the infrastructure is going to be based primarily on public, permissionless blockchains or private and permissioned ones. We had on one of the panels yesterday, we were talking about the advantages of, because of the peer-to-peer nature of it, if it's a private blockchain, you can deal with KYC, where if it's a public blockchain and you can send an asset to somebody who's not been KYC'd, that could run into problems. But there are obviously, there are pros and cons, and I'm wondering how you guys think about that, Amar.
Yeah, I think there's a few factors here. I think firstly, there's definitely geographic differences, right? I would say if you look at the trend over the last few months, I'd probably just estimate probably about 80% of the new issuances and new platforms you've seen launched tend to be on the permission side of things. I think what Siemens did with the bond issuance on Polygon was super transformative and more on the public side. So you're seeing development on both. I think it's a bit skewed to the permission side at the moment. A lot of it for the reasons you mentioned, which are, I feel there's a lot more comfort from everyone at the moment where, we talked about things like transparency earlier, where there's still pieces to work out as to how much transparency do we want. And you don't need to tackle those questions in as much depth at the moment when working on a permission network, because a lot of permission networks really do start with one party hosting all the nodes to begin with as well. So they're not actually even decentralized at the moment. So it really becomes more as it falls into your current views of like software as a service and legal contracts are in place and things. So but I do think the key thing is having that optionality, because we do not know which one the right one, what the right solution will be, and having that, it comes back to the interoperability point. Just having the ability to pivot or try and keep all those options open is key, because what we don't want to do is also, I think yesterday I remember the term, we don't want to just go straight into another walled garden, because it may well be more efficient, but I think right now we do need to keep the options open.
Yeah, absolutely. Anything to add there, Benjamin?
No, just that. I fully agree with what Amar said. I might disagree with what you said, Luis. So I think on a public blockchain you can also create your private network. You can write in a smart contract which private keys you would allow to interact with that smart contract, and actually you see initiatives that go in that direction. This obviously introduces a central vector, a centralized vector. But I think it's important to keep that in mind. And coming back to evolution, I think the evolutionary part is probably to start on a permission network, and it's going to be interesting to see how further developments are. And I fully agree with Amar. this is exactly why interoperability makes a lot of sense there.
Yeah, absolutely. Anything to add there?
I agree with Benjamin. I think it's still very much open at the moment. We'll still need to work further on blockchains. For Banque de France, we have carried out some experiments both on public and private blockchain, on permissioned blockchain. So these are quite flexible indeed. And the important thing for the central bank is, especially on the cash settlement side, to have control over the central bank money. And this can be achieved through permissions. But yes, we need to work further on. The important aspect also will be to avoid fragmentation. So this will have to be further explored, of course.
Yeah.
I think from a legal perspective and a regulatory perspective, it's so much easier to be, you know who you're dealing with in a permissioned system, and you're able to, a regulator can apply regulatory supervision to that. In terms of who's attached to the different nodes and etc. So I think from a regulatory perspective, it's much more straightforward, having a centralized permissioned sort of structure, which is, you know, similar to the trad world. I think from a regulatory perspective, it's very hard to think about DeFi and how do you regulate DeFi. And that's what people are, you know, DeFi is not even part of MiCA, right? So it's excluded from MiCA. So, but there will be a regulation of DeFi in due course. It's just about how. So I think the evolution of the regulatory framework for DeFi is more complicated.
Yeah, absolutely. I think we have the results of the poll ready, so possibly we can pull that up on the screens. There we are. So CBDC, the most popular medium for financial market transactions. Existing payment systems coming in second. I wonder if as tokenized instruments become more popular, that might start to go down a little bit. But a clear preference for CBDC over stablecoins and tokenized versions of commercial bank money. So that's, yeah, an interesting result. I think I can throw it open to the audience. We've got some time left for some questions, if anyone has any. Yeah, one over there. Thank you.
Thank you. Good morning. My question,
Sorry,
I'm John Evangelista. I'm John Evangelista from the Central Bank of the Philippines. To what extent, you said that tokenization would promote atomic delivery versus payment, to what extent do you think will be the liquidity management and efficiency benefits of netting be affected by tokenization of financial assets? Thank you.
Yeah, a really interesting question there. Is instant settlement actually desirable in a world where we've got used to netting?
I'm happy to start. It's a really, really good question because instant, I actually don't think instant, I think precision is the key thing rather than instant. Like the ability for you to say, I want to settle this at this time. And you're already seeing this in the market, you know. We trade intraday repo to the nearest minute now against JP Morgan on a platform and a product they've built, and it's been transformative in how it allows you to manage intraday liquidity and, you know, and pay interest to the minute. But I think you hit the nail on the head with real time will have challenges, and the rest of your stack has to be able to operate or at least keep up, or you have to have the processes in place, right, to be able to manage that. But I think it's actually the optionality that it gives is so crucial, and even on the 24/7 point. To some extent, I think it's a few more hours on each side. I always use the yen dollar example or Japanese government bond US Treasury example. You know, being able to cross those time zones, which should just need a few more hours on each side, could be hugely transformative and have a huge saving from a liquidity perspective versus how things work today.
Yeah, so settlement on demand rather than
Yeah, so excellent question, excellent comment by Amar. I would separate the concepts of atomic settlement and instant settlement, because atomic settlement is really beautiful. So this is pure DVP settlement. You do not have the risk that you deliver one leg of the transaction and you do not receive the other leg. This is great because this reduces settlement risk, and I think it benefits everybody. There's the instant part, which means that you trade and settle on the minute. I think this is a different ballgame and has huge liquidity implications. I think in the retail sector with instant payments, with the previous speech, this has already implications. But for the wholesale segment, this is even more different. And Me personally, I could think of a world where we see different settlement cycles. So you might have some segments where you have instant settlement, it already exists, but other segments where it is T+1 or even T+2 settlement.
Yeah.
But the atomic settlement is really...
Yeah, the reduction of the counterparty risk is the key thing there. Yeah.
Maybe I would see as another aspect to look at also the fact that you can enhance indeed settlement and you can enhance liquidity through quicker settlement, and maybe this can be done differently according to the market segment. So there may not be one size fits all solution to all these new instruments.
Yeah, absolutely. I mean, again, we haven't discussed it much, but there's a very broad universe of assets that are amenable to tokenization, and they have very different profiles for how they trade, and yeah, that could be, different approaches.
I've got a question. I mean, from a central bank perspective, obviously the risk that you don't have a settlement failure with atomic settlement. Is that preferable to having a little bit more flexibility for commercial actors in terms of financial design of products? So to be able to take advantage of the delay between delivery and settlement.
I think it would be key in any case to ensure the absolute safety of the settlement. That should be the primary objective of such a system. I think this should prevail in any case over any technological advantage. But I believe if Benjamin agrees with me.
I think this is what I tried to explain before. I think flexibility on when you trade versus when you settle might still be wished by the market participants. So it doesn't mean that you need to trade and settle instantly. But once you reach the settlement day or the settlement minute, it's good to have both legs transferring at the same time.
Yeah, we've got a question at the back there. Yeah. There's a mic, sir.
Thank you very much. Michael Brelli from Convex Foundation. I'd like to touch on your point of permissionless and private networks for a CBDC. What would it take, do you think, for a central bank, say the Bank of England, to use a public infrastructure and to retain control over it? So, for example, would you run it on Ethereum, or would you run a fork of it with a permissioned version, and what sort of restrictions and controls would a central bank want to see? Thank you very much.
Yeah, Benjamin, you touched on that earlier, creating a private network within a public chain.
Certainly cannot speak for the Bank of England. No, I don't know, to be honest. So what I can share with you is that the kind of experiments we did, among others with Banque de France, among others with Goldman Sachs, is based on a permissioned ledger, where the central bank, we as SMB, would keep tight control over central bank money that we would issue on that infrastructure in the form of a wholesale CBDC that is accessible only for financial intermediaries. So this is not issuing central bank money on a permissionless blockchain. But yeah, let's see.
Thank you. And Claudine, you...
Yes, I would very much agree that control is really key for the central bank, because, well, it's really a claim. A central bank is the claim, but money is the claim of the central bank, so it has to be completely safe. So I think we still have to work, and we still have a long way to go before deciding what is the best, let's say, system for putting this in place. It's maybe a bit premature, but it will be paramount to retain control over our central bank money.
Any other questions? Yes, thank you.
Yes, I'm just curious to hear your thoughts on programmability. You know, we've heard from UK officials and ECB officials that that a digital pound, digital euro wouldn't have that. So just kind of, do you think that's a feature that is then would switch into commercial private bank money in the tokenized assets? So I'd love to hear your thoughts on that.
Thank you. Yeah. Anyone want to jump in?
Well, so I think it's a question of what features of the CBDC, the programmability provides. So if it's just about sort of, you know, you get paid, you know, at a certain, you program in the contract, the payment of the CBDC to somebody else for, I don't know, a dividend payment or something like that. I mean, that would be interesting, but you can't change the nature of the currency, right? You can't change the fact that it's going to be a pound, an equivalent to, you know, a note pound or, you know, pence. So there are limits to programmability, which can be allowed, I think, which I understand central banks are looking at, and that needs to be defined. Again, coming back to the law, you know, the ability of a central bank or the powers of the central bank to be able to issue CBDC, which is equivalent to legal tender and is defined as currency, would also need to define to what extent programmability is possible. The other question is, you know, should a central bank CBDC be interest-bearing? And I think that from a monetary policy point of view, again, I'm not an economist, but I understand that is, you know, it is a problem, because then you've got a differential between the nature of the CBDC and the fiat. And so, you know, does that change the price of the CBDC versus the fiat? And that creates a huge problem within the economy, I think. So, you know, the level of difference of what, from a programmability perspective or interest-bearing perspective of the actual CBDC itself needs to be defined, but also limited by monetary policy.
Thank you. Well, we're running quite short of time, so I just wanted to, on the programmability point, I think, you know, the programmability of the money is one thing, but one of the things that is a potential big outcome of tokenization that we haven't really touched on is assets that are programmable and, you know, automated payment streams and, you know, controlling who holds them. And I wondered if we could maybe touch on that before we wind up, if I can leave that open to anyone.
I can kick off with taxonomy. That's what central banks do, I think. I would differentiate between programmable money and programmable payments. I think programmable payments we already have today. So I can pay my insurance bill automatically. So I can inject that in my e-banking tool, that this is executed automatically. This isn't too different than with what we have today. Also, I think EVP is kind of a programmable payment, because it executes the payment once certain conditions are done. I'm struggling with the concept of programmable money, and would be glad to also after the panel to discuss this in further detail. One aspect for me where it's really programmable money, it is potentially about the interest payment that, or the remuneration that Monica has talked about. And there probably also differentiation is needed between retail and wholesale CBDC. So opening up more questions, I guess.
Sure.
Yes, I would agree. I think that, I mean, this concept of programmability has to be further refined. I would think maybe on the usage of possible new features like smart contracts. These could be embedded within the future infrastructures, maybe to enhance liquidity, for example. I mean, this is what we are, well, working on the Mariana project, notably. So it could be an added value to using CBDC.
Yeah, and anything to finish off on?
I guess just on this, it's a really good point, because I think we're yet to see the full potential of the programmability side, even on the asset side, and it's linked to the money side of things, because people often go to the first programmable point being, as Benjamin said, like a coupon payment, right? Or at the same time, we're not yet at a point where we have scalable forms of digital money which can be held on an overnight basis, because that itself opens up loads of different questions like the legal definitions. I think we're super early in the journey. I think there's so much potential, but I think along with interop, that's going to be one of the big themes of the coming months and months of new trades that you see in the market.
Yeah, very exciting developments. Thank you to my panelists. I'll let you all go for a coffee break now, and then we'll be back at 11 for a panel on regulating the global crypto landscape. So hope you enjoy.